Welcome to the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. We are also 2/3 of the team at unfilteredinvestor.com. Thank you guys so much for checking it out. I know a lot of you have been on that site and been looking around. Thank you guys very much. Bobby, so the rotation seemed to happen somewhat elegantly over the last couple of weeks. 3 months ago, did you think if we said that the Mag 7 were going to lose 15%, Microsoft's going to lose 30%, you thought that the broad market was going to get shot right to the nards, right?
Absolutely. I thought we'd be a lot lower than this. We're still going. We ended the quarter, one of the best quarters for the indexes in I don't know how many years. I mean, it was a really good quarter despite what just happened. But that doesn't mean it's not going to continue. That doesn't mean it's not going to reverse. That sounds like one of the weakest things I've ever said in my entire career here. But I think the rotation overall is a good sign. You know, you look at something I looked at today was the Bank of America Bubble Index. You ever seen that?
No, tell me.
The Bank of America Bubble Index has AI at like 91, overall tech at like 69. These are very high levels. Now, I don't know what goes into the index itself, but they make this claim that their index is, you know, every time there's a bubble, the index has been above 90. I don't know. I mean, how many bubbles have we seen and what does Bank of America cover? So I don't even know what I put into that. I don't think this is a bubble the way we've talked about bubbles before. I just think these things might be a little overvalued, and that's why this rotation's happening.
So I hope that they're using, because Schiller, who won the Nobel Prize for defining a bubble, I had a conversation with him, and yes, I dropped names. And he talked about leverage and euphoria. And I said, to me, it also has to be mom and pop leverage. You have to draw in weak hand leverage. It can't just be weak hand participation. And he said, oh, yeah, that's not a bad idea. Perhaps I should have put that in my definition, which I don't know if it could have been any better because he won a Nobel Prize for it.
Here it is really quick. Bubble risk indicator now reads 0.91 for semis, 0.82 for tech, and 0.69 for the NASDAQ 100. So that represents the highest level of risk. It's 0.91 that they've seen in 10 years.
Okay, but that doesn't mean that the whole index has. Anyway, we have one of our favorite guests waiting in the wings. I've said this a million times. I'm going to say it again. You could have watched Bobby and I on TV for the last 25 years and think that we're full of shit. That's fine. Sometimes we think we're full of shit also. But one thing you cannot deny is we get some unbelievable guests. This is one of our favorite guys, one of our favorite analysts. Let's bring in Brent Johnson from Santiago Capital. Bobby, I told you I had dinner with Brent and Jim Bianco, and I dumped a full glass of red wine on Brent's lap, didn't I?
Yeah, you told all of Twitter that.
Yeah, as a matter of fact. Again, I blame him. He's having dinner with a couple Italians, and hands are going, one of us were going to knock the wine over. You should have sat at a different table and shouted over to us, right?
Yeah. You know what's funny, Jim, with that intro, I thought you were going to say the guy we have coming on now is full of shit. So I thought I was just going to be one of you guys.
No, I actually think there's very few have been as prescient as you have been over the last couple of years, particularly about things like the dollar, which I guess we'll just get right into it. I did want to talk about basketball. Maybe we'll save that to the end of the show. But your opinion on the dollar, the dollar milkshake theory, and then now the latest thing I read, which I know is proprietary for your clients, so I don't know you get into it as much as you want. But I want to get, how about give you the state, give the State of the Union on the dollar right now.
Sure. Well, I think the easiest thing to say is the dollar ain't dead and it's not going to die. And if and when it ever does die, it's going to die of strength, not weakness. And part of the reason I've probably spent more time than needed pounding the table on the dollars, I just think it's so misunderstood. And not only is my thesis, I actually don't think it's that hard to understand, but I think there's several people who are committed to not understanding it. And the thesis is basically that the United States dollars, for all its faults, is just so much superior to all the other fiat currencies that I don't think it's going to get replaced anytime soon. But the investment recommendation is not just to sit in dollars. The implications of the dollar being very important and not going away anytime soon, I think, is that the United States, despite all its problems, is still the best place in the world to invest. And still has the ability to kind of throw its weight around. It still is the safe haven when things go wrong. And I just don't see another option out there as far as a country, region, or area that's going to displace that anytime soon. Now, that's not to say that bad things can't happen here and we don't have issues, and that nothing can ever go wrong. But when you're a trader or an investor, you are allocating your capital somewhere, right? It's a relative game. Unless you're just going to sit on the sideline, you got to get in the game and you got to play. And I think the United States is the best place to do that.
So I have two follow-ups to that, and I'm going to say them both at the same time. You can take them in either order. First, foreign direct investment has jumped pretty substantially year over year. I wondered if that is a consequence of what you're saying, just the cleanest shirt, or is it the tariffs that people want to reroute their supply chains here? And the second part I'm going to follow up after that with is that I do think the strength of the dollar has caused some bad actions in this country. We do know the stewards of our currency know that it's the best out there. And I think they're borrowing too much and spending too much. And if that puts us in a 5% chance of a dollar calamity over the next 20 years, to me, that's too much. Let's go with the foreign direct investment one first.
Yeah. So when I first started talking about this back in 2018, 19, I think the balance of foreign direct investment was like $18 trillion. And people told me that, Brent, that's a great thesis, but it already happened. It's been happening for the last 20 years. You look at this chart and it's up and to the right. It's a good theory, but it's done. And it's essentially doubled since that time period over those 8 years. Now, that's not to mean that there hasn't been a few dips along the way, and it doesn't mean that it can never change. But when I look around the world, I just can't figure out where I would rather put my capital. And as a result, if I'm putting myself in other people's shoes, they may like the idea of putting capital somewhere else, but when it comes time to actually risking their money, they tend to still put it here. And when I look at the options, do I want to go invest in Europe, which has crazy regulations, bad demographics, and a war on their border? Not really. Do I want to go to China, where they've had a real estate collapse but haven't recognized the losses yet, and they have capital controls? Not really. Do I want to go to Japan, where the currency continues to fall, and again, they have a very precarious situation? Population. I actually like that better than the other two opportunities, because if the currency falls a lot, then maybe the assets go up. But I still don't like it better than the United States. And so when I just go down the list, I kind of end up back in the United States by default.
Bobby?
Brent and Jimmy, there's that old saying that I'll probably butcher, but something about the only way that evil triumphs if good men do nothing, right? We don't have to use the word evil for the tax and spend debt spiral that we're in, right? We could say stupid.
Yeah.
We could say unsustainable over a long period of time. I agree with you, Brent, that I don't know that I'll ever see a debt spiral or a dollar collapse because of our debt. I may be too old to see that. I think I'll age out of my life before anything like that happens. How much gold or Bitcoin or both would you tell people to, I don't want to say invest in, but to maybe hide in, just in case that time frame is a little shorter than probably the three of us think? At least you and I think it. Jimmy maybe a little sooner.
Yeah. So, one of the points I've always tried to make is, listen, there's actually nothing better for gold than a strong dollar, because a strong dollar will wreck the monetary system. It will cause crises, and the response to those crises will be more stimulus, more bailout, and so I think that we've kind of been in one, but I think we will get into an even bigger time period where the dollar rises versus foreign currencies, but the gold rises versus everything. So dollars and gold will rise together versus all others. So I've always thought people should own gold. I've been a big advocate for gold. I'm just not a big advocate only for gold. And I have found that when you venture into the gold community, if you don't say the dollar is going to die, and if you don't put 100% of your portfolio into gold, well, then you're just not doing all you could be doing. Right?
Is that the same in the Bitcoin community as well?
Fair. Yeah. I think a maxi of anything. I would say if anybody has 100% of their money in dollars, that's not a good idea either. I'm not a maxi on anything. I think everything is good in moderation. I have always kind of, advised clients, anywhere from 10 to 25% of a gold allocation to their portfolio. And it kind of depends on their personal circumstances. It depends on their risk tolerance. It depends on their other sources of income, et cetera, et cetera. But I think 25 is plenty. And I think you should probably have at least 10%. And I think 25% is plenty. So that's kind of how I've kind of come down on that. And I still think that that's true today. Even, I mean, we've had a huge run up, we've had a big pullback, but I still think that that's true today.
So the second part of that is, do you feel the same way about Bitcoin? If not, why? And the follow-up to that, so I don't have to ask Jimmy to allow me another question, is do you think the U.S. will go as far as to use military force for whatever reason to maintain the dollar's reserve status? Because I think they might.
So on the Bitcoin, I do not look at Bitcoin the same way I look as gold. I know there's a lot of similarities. I know a lot of people think of it as digital gold. I view Bitcoin as a pure play on global liquidity. And so I think when markets are liquid and money's flowing, Bitcoin probably does pretty well. Now, the last 6 months, you may say that hasn't exactly been the case.
Right.
But Bitcoin, while it has some of the characteristics of gold, it has never once proven itself in a crisis. Now, that doesn't mean it won't, and it doesn't mean it can't. But in the 15 years I've been watching it, it hasn't done it. But I've got 5,000 years of history when I look at gold. So I have a little bit higher conviction that gold will. And here's the other thing is, either one of them, I don't think gold or Bitcoin is for the crisis. I think it's so that you have insurance during the crisis and you still have some capital intact after the crisis. And what I mean by that is we can just use the last 4 months as an example. Gold had a huge run up leading into February. And then we had the Iran crisis. And what did gold do? Rather than, it jumped on the first day, and then every day after that, it basically fell, and it's down 25% from its high. And that's because as gold increased as a global reserve asset that central banks and other asset allocators are holding, it's still a dollar asset, and you still need dollars to operate on the global stage. And so when they got into a crisis and they needed dollar liquidity, you sell the gold to get the dollars. Now, that may change someday, but as of now, that's still the case. And so over the last 3 or 4 months, we've seen Russia sell gold. We've seen Turkey sell gold. We've seen the Gulf states sell gold. We've seen countries that needed to buy energy that was now much higher priced and priced in dollars had to sell gold in order to get liquidity in dollars. So but I also think that gold could very well rocket back higher. And if we were to go back to some kind of a QE or cutting rates scenario, I would expect gold to appreciate quicker than most everything else.
Well, I have a quick confession to make. When you said Gulf states, I think I'm getting old. I was thinking like, wait, Louisiana and Alabama are selling gold. And then I realized, I swear to God, there was like 4 seconds. I was like, what is he talking about?
Sorry.
Oh, no, I'm the idiot here. Please continue.
Hey, Jimmy, can I just have Luis put up a chart and that I just posted on there, and you guys can tell me when you can see it, because I'm not looking at our feed anymore.
I can see it.
I can see it.
All right. So this is from the end of 2021 through, so figure January 2022 through about June 29th of this year, and you're seeing cumulative return, CAGR, and then volatility of 4 assets, right? And you can see that when you take volatility into consideration, gold has been the best over that period of time. I think, to your point, that as the dollar was weakening and then strengthening, gold still outperformed on a risk-adjusted basis. Would you agree?
Yeah, no, and if you put the, if maybe not over this same time period, because the dollar got very strong in 2022, but if you took it back to 2018 or 2020, the dollar has actually gone up since then. So over short periods of time, dollar strength is a headwind for gold. But if you zoom out, from 2008, when the DXY was around 78, it's now at 100. But over that time period, gold's gone from $800 to 4,000, right? So the dollar, my point is that the dollar going higher does not necessarily mean gold's fall.
All right.
Now, before I forget, I know you asked me, do I think the U.S. would use the military to reinforce the dollar if necessary?
I forgot I asked that.
And my short answer is yes. I don't think they need to do it. I think the market largely does their work for them. But if and when it ever came to that, I absolutely think the United States would do that.
It's so funny. I asked Peter Schiff and I were in a debate once at the New Orleans Investment Conference, and I had said something, that the dollar, he's like, it's backed by nothing, and I said it's backed by flat tops and nuclear weapons. It is backed by something. He goes, what if if they're gonna drop a bomb on someone for not using the dollar? And I was like, yes,
yeah.
Right.
I mean, they won't say that's why, right? They won't announce that's why, but they'll do it.
Yeah.
Well, so it's interesting you guys bring this up now, and I sent my paper to Jim. I know you wrote it.
Loved it.
And it's and Bobby, if he didn't share it with you, feel free to share it, Jimmy.
You never
told me to share it with no one. That means no one to me.
Well, listen, no, it's actually, if anybody wants to read it, you can go to research.santiagocapital.com and you can sign up and get it that way. But we put out this. I have talked a lot about the dollar over the years. I haven't written that much about it. So I wrote a fairly long piece on the dollar because I wanted to have kind of a reference that people could look at and say, this is kind of the way that I think about it. And there's a section in there we use the Rolling Stones as a metaphor throughout the paper. And there's a chapter in there we call Paint It Black. And what we meant by that is we think we're in an environment now where the United States is not necessarily the bad guy, but they're also no longer trying to be the hero. And while they used to kind of view themselves as the bright, shining city on the hill, they are no longer pretending that we're all in this together and it's the greater good. It is now America first, and if you don't like it, too bad. Now, there's good parts of that and there's bad parts about that, but that's kind of current reality, right? And so the Paint It Black refers to the United States using the dollar as a weapon. And in the last year, we've seen Besant not only do that, but publicly say so. The swap line was used in Argentina to help them because they're an ally, but it was also used to get Argentina to get rid of their yuan swap line, to stop allowing China to have a Navy base in southern Argentina. And guess who now sits at the front of the line to extract resources if and when it comes time to do so, right? Yeah. That's weaponization of the dollar via a swap line. He also publicly talked about creating a dollar shortage in Iran prior to the conflict, and they know how to do that. And then finally, just a couple of weeks ago, he talked about the way that they have been using their tools to confiscate stable coins and digital assets controlled by the IRGC. So I have no doubt that if and when needed, the United States will weaponize the dollar to its advantage. And the other thing I'd say is the United States is not the only one. Canada did it to some of its own citizens and the truckers a couple of years ago. There's countries all over the world have confiscated savings and frozen bank accounts and put up capital controls. So this is part of the reason I talk about the dollar so much, because I think currencies are probably one of the biggest factors that goes into global asset flows and investments and portfolios. But I think they're the least misunderstood, or the most misunderstood and most considered, or least considered. And I think they really should be a bigger part of investors' thinking when they are allocating assets.
Bobby? Oh, because I do have another question if you don't have a follow-up. Okay,
no,
good.
Go ahead.
Okay, so I have a thesis about the recent movement in the yield curve, and I know it's been somewhat small, but here it is, and I want you to tell me if I'm wrong or not, because I was actually thinking about writing about this on Friday. Okay, so Kevin Warsh takes the helm of the FOMC, and his first time out of the gate, he sounds more hawkish than people expected to it. I personally think that's a dude psychology thing. If the world thinks that you sat across from the president and were cowed by him to lower rates, the first thing you'd say is, no, I'm my own man, and that's what I got out of it. Okay, now the market seems to be pricing in that potentially they will raise rates at the July 20th meeting, which the question is, how far are you willing to go? Now, that's not the part I'm interested in. What I'm interested in is that I believe the market is saying they are fighting a demon that probably is already on its way out the door. And I'm talking about the recent supply shock inflation that fed through pretty quickly. I think the fact that that 2s versus 10 has gone from 56 to 26 in the span of about 3 weeks is the 10-year is saying, okay, sure, they might tighten, but it's stupid. There's going to be no inflation, and it might push us toward a recessionary environment if they follow through on it. I know it's a small movement. Do you like that thesis?
Yeah, I do. I think that's largely correct. And I think behind the scenes there are deflationary pressures, and without the recent conflict. And let's not sugarcoat it. I think the inflationary effects of Iran have not yet really shown up, and I think they probably won't show up for another couple quarters.
Okay,
but that doesn't mean they won't show up, right? But without that, I think we would be in more of a deflationary environment rather than an inflationary environment.
So I think my last thought is then, Bobby, your question, but I think my thesis on oil was that by mid 2027, we're looking at $45 barrels of oil, because at that point in time, UAE is cranking, Venezuela's cranking, Iran is probably back. I assume this will be in our rearview mirror along with supply chain things. So that actually doesn't necessarily disagree with your couple quarters of it lingering, correct?
Correct. And I think it's possible. And I already know how people are going to react to this.
Love it.
But I think it's possible that this whole conflict with Iran is solved in the next year, perhaps in the next couple months, right? Now, that's my base case, is that this truce or this cease, whatever you want to call it, is not going to hold. I think that there will be further conflict, but I don't think this is going to be a 3, 4, 5 year quagmire that, many other people have said this is certain to be. Now, if it turns out to be that, I will come back on here and I will raise my hand and say I got it totally wrong. Yeah. But once if and when that is solved, I think it's possible, we get oil back in $50 range, $60 range. That doesn't mean there's not going to be some big spikes along the way. So I'm not trading oil as a result, because I don't feel like I have an edge of how to trade it. But what I would say is right now, I think oil is probably going to make a low sometime shortly after July 4th. And then I expect hostilities to pick back up. So I think Q3 will see higher oil prices.
Yeah, by the way, I agree with that completely on a medium-term basis, so to speak. I think that oil is trading for perfection in the peace process right now. And these are, between Trump and Iran, show me the perfection in terms of diplomacy, right? It just doesn't exist in that particular combination of people, that combination of leaders of countries right now. So we actually, in our newsletter this week, we put a potential long in XLE. Based on that. Now, it hasn't triggered yet. We are not long XLE. I need to clarify that to the people watching us. But there is a scenario where we actually buy XLE for maybe a 2 or 3 week trade, because I think it could snap back. But I do think you're looking at a fractured supply line that needs to be repaired, not just a supply line that's been blockaded and needs to be reopened. You talk about just the physical aspects of the wells themselves that have been shut in. I've talked about this on other shows, but when you shut in a well, there's something called oil wax or oil cement that happens, where some of these wells are going to need to be re-drilled. Now, it's interesting because Iran obviously was letting some ships through, or the U.S. was able to escort some ships through, because Iraq is already getting tankers back and they're refilling and going out a second time. There's no way logistically those weren't getting through prior to the peace agreement or the MOU, because otherwise they would just be leaving. They'd just be arriving in port now, if you just look at the logistics of it. So some ships were getting through. So shocking. The media was lying to us about some of the oil that was coming out. It's just, I'm shocked by that. I can't believe it. I'm completely distraught. But it will take a while to get into the 40s. But I think Jim's right. 2027 in the 40s. It is extremely realistic. I want to ask you about inflation more generally. Is the inflation bout we're going through right now only because of crude oil? Was there some maybe tailwind to it because of the tax returns increased by, I think it was 11, 12%? Then I want to ask you about deflation and what's driving it, because I don't disagree that we'd probably be in a deflationary scenario. Are you looking at AI being part of the reason? And I don't want to trap anybody. I was reading a story, I think it was in the Epoch Times, which that's for what it's worth. But they said that 9 of 10 companies surveyed by them, I don't know who these companies were, said they would rethink their AI layoffs at this point in the trend of AI. And they also said that only 8.4% of the companies surveyed are getting the return on AI they thought they would. The title of the article is "We Want Our Humans Back." That was a long question. I'm done.
We don't even remember what the question is, Bob.
Yeah, I don't know what the question was.
I think it had to do with inflation, and then it.
Oh yeah.
So okay, so I think I don't remember exactly how you worded the question,
I
so I
don't
hope
either.
this answers it.
Was inflation
But,
only crude driven, or were there other
No.
factors?
So, okay, so that's what I said. I right now, again, I don't think the inflationary effects of the Iran conflict are showing up right now,
Okay.
to be honest, or maybe a little bit, but not a lot. But I think that has the potential. I know the setup is there. Whether it comes true, I don't know. But I think the setup is there for an inflationary spike, kind of late Q3, Q4, Q1. And it's not just energy driven, but it's food driven. And it could be energy driven from now going into the winter and needing more, Europe needing more natural gas for heating. And I think it's a setup for crop yields to come in lower than expected because fertilizers, chemicals, et cetera, didn't get out of the strait while it was closed. And therefore the planting season, both in the Northern Hemisphere and Southern Hemisphere, took place without the traditional levels of, fertilizer that goes on them. And then it's an El Nino year, and that can play havoc with crops. So I think it's possible we get into Q3, late Q3, early Q4, the crop yields start coming in and they're not what they were expected to be. And then if the conflict in Iran is not yet solved, and then we also have higher energy prices, now what you have a scenario where you can have high food prices and high energy prices. And what that can then lead to is the countries that are most affected by those. And that is traditionally kind of Southeast Asia, some of the peripheral European countries, some of the Middle East countries. And so I don't know if you guys remember this, but it was about maybe 10 or 15 years ago, all across the Middle East and Northern Africa, they had the Arab Spring, where these big social protests against the governments. Well, the reason they were out there protesting was because fuel prices were high and food prices were high. Right, when people are warm and well fed, they don't typically go out and shake their fist. But when they're cold and hungry, they get pissed off, right? And so I think we have the potential. I know I'm kind of jumping around. I think we have the potential for that later this year, early next year. And I think that is also why Trump and the U.S. so tried to push for this ceasefire so hard, because they knew if they didn't take a pause and they didn't get oil flowing again and they didn't get things kind of back to normal fairly quickly, the odds of that happening around election time, right, would be higher. Not certain, but be higher. And so I just think Q4 is going to be crazy.
Can we take a quick break? Luis, will you put the banner up? You guys who are watching the show and watch it every week, I'm going to ask you for a favor right now, and I appreciate all the support you give us, but please scan the QR code and try Tradier Pro for free for 3 months. We talk to people who trade options for decades and people who trade options for days, and they all say the same thing about it. It is the gold standard. Actually, gold is probably not the right thing, considering it's gone down 25% since just again. But what used to be the gold standard of options trading platforms is Tradier Pro. So please do us a favor, scan that QR code, and now back to the show. Bobby?
Yeah, I do think, would you guys agree that Scott Bessent is involved in virtually every decision by this administration? Would you agree that he probably chimed in and said, yeah, if you're going to do a war that might affect oil prices, now's the time to do it?
I think he's definitely involved in some of the decision making, and without question, I think when the decision to do the whole Iran operation, I think they probably saw a window where they thought maybe they could get this all taken care of in 3 or 4 months, right? And it turned out that Iran had better staying power than they thought. They weren't able to execute their plan to the same level that they thought they could, and they kind of ran out of time. And from that perspective, Iran kind of was the winner because they ran out the clock, right? The United States wasn't able to score the goals. The time expired, and it's but I don't think the game is over. Maybe the half is over, maybe the first quarter's over, but I don't think this overall game is over. But to your point, I think it got into late May, early June, and they're like, we need, if this goes on much longer, it's almost certainly going to be chaos around the midterms. Yeah. And if we stop now, perhaps we can paper it over until after the midterms.
Do you believe that Scott Bessent is really taking a swing at two different people in the White House? Do you know these stories, right?
Yeah. I actually think it's probably true.
I do too. Because again, I worked on a training floor, but I've taken a swing at guys twice in a work environment before, and I'm not Scott Bessent. But again, we were on a trading floor, slightly different than the White House, I would say. But I'm impressed.
Well, but I mean, publicly, he's pretty. He is not afraid to be abrasive publicly. So, and that's why I say behind the scenes. I mean, you know this, right? Behind the scenes, like you said, you sit on a trading desk, you can come to blows, right? And so it wouldn't, and think of the stress that these guys are under and the situations that they get put in and the stakes that they are playing out of. I wouldn't surprise me at all if I've never met him, but I've heard he's 6'5" and a big guy. So
big guy, right?
Yeah.
And by the way, Dave Coleman, if you're watching, I know you cracked 2 of my ribs on a trading floor, but you were on Vicodin for 10 days because I tried to screw your head off your neck. So we are even if you are watching this. But anyway.
Yeah, I think it's refreshing to watch him testify before Congress because he just will yell. You don't know what you're talking about. They're just a joy. Yeah. And I forget his name, but I think he's transportation secretary. He's started taking a few lessons from Bessent. The last time I saw him speak, for the life of me, I can't remember his name.
Oh, I know who you're talking about.
I'm talking about Duffy, I think it is. I think it's
Duffy. It's Duffy.
Yeah, he was yelling to somebody. They're asking him, "You're taking trips on the American dollar." And he goes, "What about you? You took $1 million from pharma. What about you? I have it all here." And he's got like her ledger of received donations from some of these companies of joy. Yeah. I want to put something up that came in the comments and have you guys talk about it. Widge, of course. I look at these many versions of tax-deferred savings and retirement accounts and see them as fertile ground for future confiscation via tax rule changes. What do you guys think about that?
I wouldn't. Let me take it first, Brent. Yeah, amen. I mean, the fact that we are in their crosshairs. I don't think there's any question about that. And I think the pushback we're getting, Brent mentioned something about the Arab Spring where the people push back. We are seeing a close cousin of that right now with all these democratic socialists who are the same as communists. And some of them even say they're communists. But to think they're going to come after our money because we've done well, I think is 100% reasonable. And I think I would put my money on that it happens. You, Brent?
Yeah, I think people need to understand that even when the government, your party is in power, they are on the other side of the table from you, right? Yes, it's the people,
they want money.
It's the government, and they are not sitting on the same side of the table, right? And money is one of the biggest tools that governments can use to encourage the action that they want to happen, right? And they will, if needed, I don't think they will want to do it because it's not easy to take somebody's money, right? It's not that they won't, but it causes friction. And if they can do it without friction, they would prefer to do it without friction. But if they need friction and they need the money, they'll take it. Yeah. And I think that's been proven many, many times throughout history.
And I think you said the word need the money. That's kind of almost sarcastic, right? They could just not spend as much, right?
Yeah. Well, I mean, we both know the answer to that question, right? Of course they're going to spend it.
Let's spin back to markets a little bit. I think what's happened over the last couple of weeks, we were talking about this. We were talking about this before you came out. Is if you would have told me 3-4 months ago, with the narrow leadership we had, that those names were going to take it on the chin and the rest of the market would handle it with a yawn, I would have said you were crazy. Do you think that's a sign of strength for the broad market?
So here's what I'll. First of all, I am surprised as well. Considering how much Apple's down, how much Microsoft is down, some of the other tech stocks are down, some of the other bellwethers, right? They're down quite a bit. And because of the effects of passive management and that impact, I would have expected as those leaders rolled over, the overall market would have rolled over with it. I think the reason that hasn't happened is largely because jobs have held up despite those pullbacks. And as long as employment is still high and as long as 401k checks are still getting deposited and though they're automatically buying stocks, I think that's why the market has held up. So while there has been a rotation, there has not been an outflow, right? And so to your point, if the mandarins and the people that are trying to manage all this, if they could keep the market high while bringing some of the outliers that have run up so much back, this is exactly what they would want to see, right? So I think it actually is a good sign to have the ones that have gone exponential to pull back a little bit, because it takes some of that air out of the bubble, if that's the right way. It's not saying the bubble doesn't still exist, but it's kind of letting some of the pressure out of it and letting some of the others catch up. So I'm not expecting a huge stock crash or another Great Depression. I'm not in the camp that, we've got this 5-year bear market ahead of us. I think it's going to be very volatile. My guess is that the next 5 years looks a lot like the last 5 years. And what I mean by that is 5 years from now, stocks will be a lot higher, but there will have been 2 or 3 dramatic, scary drawdowns along the way.
Yeah, I have a target, and I'm using the futures for this, just so you guys know. I have a target on the NASDAQ of about 2665, 26065. I think that's extreme. Like, I don't actually think that'll happen. Like you said, stocks are really the only asset that have a sort of permanent upward bias, right?
Well, Bobby, are you saying you're a bear, that your target is 20?
No,
like if we start to crack is what you're saying.
I am in accumulation mode, and I've been in accumulation mode for about the past
That's what I
4
thought.
or 5 weeks.
I thought I was misunderstanding you. Sorry.
No, I've just been buying smaller positions because I know if it goes a little bit lower, I'm going to buy some more. Now, this brings me to, go to what Widge said or any of this stuff. Brent, when you talk about gold, I hate to bring it back to gold, but I just love gold so much. And it's my largest holding right now, which I'm trying to work out of and go into some of these things that are beat up. But it's my largest holding, and most of it is physical. Is that what you talk about when you talk about that, anywhere from 10 to 25%?
Yeah. So I think, I've always been somebody who thinks everybody should own physical gold, right? Mm-hmm. But if you want to have some combination of gold and silver and the miners, I think 25% is enough. But I tend to lean towards physical bullion because, to me, gold is insurance. I don't hold it to make a bunch of money. I'm kind of going to hold it regardless of whether it's going up or down. I don't really care what the price is, because that's not where I'm trying to quote unquote make money, right? Mm-hmm. And so we've owned it for a long time. We didn't chase it running up because we already owned enough, and we haven't started buying yet as it's pulled back. Now, if it pulls back to kind of the 3,600 range, I would probably buy some, because I think there's really strong support there. I think we got pretty oversold on the daily level, and so we're probably due for a bounce. But I still think it's very possible that we, test the 3,600 level in gold, and maybe the, $45, $50 level in silver. And I got to say, there's so many people have pointed out bottoms to me in the silver market over the last 3 months. They've pointed out more bottoms than the first time I went to a strip club.
Oh, good one. Did that just come out naturally, or did you have that in your pocket waiting for it?
I actually had that one in my pocket waiting for it.
I know you always get an honest answer.
I thought you might ask me about gold and silver, so I was ready.
I like that a lot. Okay, so before we talked about, because gold and silver involves the Fed, I think you're going to disagree with me on this, which is good. I don't mind that at all. Like, I think the Fed will be making a mistake if they hike in the 28th. You, based on some of the things you've said earlier, don't think so, unless I'm misunderstanding you and you don't think that hikes handle supply shocks. What are you saying as far as the Fed?
My base case is that they don't hike, but I will not be surprised if they do.
But what should they do?
I don't think that they should hike.
Right. Yeah, me too.
But you know what? Yeah. To be really honest, I don't really talk too much about what I think they should do, because it doesn't matter what I know.
That's a great point. That's an excellent point, because it doesn't matter. We're supposed to react to what they do. We are not the Fed. If we were the Fed, we'd do a better job than you guys. You guys are a bunch of boneheads for the most part, historically speaking. But that's Bob. You are right, Brent. Bobby?
So I want to go back to what I just said, where I'm accumulating right now. Would you say that it's too early to accumulate, too late to accumulate, or should people just be buying stocks? This is obviously not a recommendation for people, but just sort of in general. And if so, where would you point them?
Okay. So if somebody came to me and they had a huge portfolio that was all in cash, then I would buy some stocks now. Right? I don't think you should just be sitting 100% in cash. But if somebody comes to me right now, I would not put their whole portfolio to work in stocks right now. I would buy some, but not because I think that we are going to have volatility in the second half of the year. I think there will be an opportunity to buy at lower prices. And perhaps I'm wrong, and that's why I would buy some now. But I think it's considering the volatility that we've had and all that's gone on, we're still within what, 2, 3, 4% of the high?
Yeah.
I mean, that's pretty high, right?
Yeah.
I mean, so, you know, if we were to pull back 5 or 10%, then I would buy more, right? I would put a little bit more in. But I considering what I think is going to happen in the second half of the year, I would have to see a pretty significant drawdown to get excited about buying stocks. I'm not expecting a 20 or 30% drawdown in the second half of the year, but if it comes, then I would probably be a buyer of it.
So I'm going to
read. If you're currently holding, you're not selling things, right? At this point.
That's right. We have equities. We're holding equities. We have some hedges. I mean, with the VIX back at 15, 16, 17, we,
Gotcha.
Not too expensive to buy some hedges. And we have, we have some T-bills and stuff that that helps. But yes, we're long, but we have some downside protection.
So
that's kind of our standard, by the way, that's kind of my standard. I always have some kind of downside protection. It's just a matter of how much, right? So,
and I've had more this year, but so my thesis has been, I'm going to dust it off from about a year and a half ago. And I probably had shared it with you, but if I haven't, one thing I said that I thought was going to happen is that with Donald Trump as a president, he's a headline bomb. He causes short-term volatility quite often and then walks it back a couple of days later. Now, the interesting thing is that I believed that would make for a more durable market longer term by constantly reminding us that there's the potential for short-term volatility. And it's kind of played out a little bit. Is it too early for me to say that I'm right on that? Yes, I guess I'm looking for an attaboy, but whatever. We've averaged about 18.5%, 19% over the last 12 months in the VIX, which is normally 16%. Do you think that's a manifestation of what I'm saying?
Yeah, I think it is. I mean, when you got a guy like that in there, and then you've got a press who hates literally everything he does, so they're going to amplify that. And then you consider that we're in an environment where the world is no longer cooperating. You just have the potential for a lot higher volatility. But I also think that for all his faults, which we could spend the next 10 hours talking about his faults, I do think what he is doing to try to revitalize American innovation and manufacturing and getting people to stop apologizing for being American, I think that is a positive thing. I think the tariff, I don't love tariffs. I'm a free market guy, but that's not the world I live in, right? The tariffs exist. They exist all over the world. Every other country uses them. And the idea that countries are just going to automatically start manufacturing here if we ask them nicely, I think is wrong. But I think with the policies he's put in place, I think they will manufacture here. You've seen companies moving manufacturing here. Now, has it been a stampede? No, of course not. But I think it is happening. If you look at trucking, I don't remember the exact number, but there's a trucking number that shows how much transportation is around the Midwest and kind of the old Iron Belt. And it's been going up over the last year. And that's because there's increased activity within the United States. In other words, it's not coming from the coasts. In other words, it's not imports coming in and being shipped to the middle of the country. It's the middle of the country trading with the middle of the country. And it's because there's increased activity, economic activity domestically. And I think that is a result of Trump's policies. And the last thing I'll say is, if you don't like the way that we have had the direction of inequality, and you don't like the fact that Main Street has been left behind, and you want there to be better paying jobs in the United States, if you don't agree with how Trump is doing it, then what the hell did you want? Because the last 30 years certainly didn't produce it, right? And so, I think Trump has done many things wrong, but I think he's done several things right. And I think, again, I just get back to, I think this is going to work better than many people think.
Just is so funny. Like what you just said, I gave a speech last night at an agriculture conference. I basically said everything you just said, almost word for word. It is
all right. We're simpatico.
We are simpatico, Bobby.
Yeah, I want to put up a couple of comments again. Widge says, as we had discussed last week, unfortunately, nothing was really codified. That's a fatal flaw to the tariff policy. I'll say this to that comment. You're absolutely right. But when we had some of the tariffs put on China and then Trump lost to Biden, Biden didn't remove them. So it is possible that they don't give him credit and they leave some of these on if he's out of office, or rather if the right is out of office, if JD or Marco or whoever runs doesn't win. It is possible they just leave it alone and they don't give him credit for it. But it is a flaw, I agree. And then Steve says,
I will agree that it's a flaw, but the word fatal, I think puts us in a little bit of a disagreement, Widge.
Yeah.
So, you know, somewhat related to this too, there's Japan and some of the other countries that paid tariffs over the last year are now asking for rebates. So my question would be if the United States consumer is the one that's paying all these tariffs, then why are we sending money back to Japan and Europe, right?
Yeah.
Maybe they did pay us some money, right? In other words, if they didn't bear some of the cost,
this would be one of the times where I would be, behind the idea of just not paying them. I mean, you can't tell me that.
I will say I will be surprised if the Treasury actually sends money back to these countries.
Yeah, I don't think they're going to.
Well, Donald Trump's opinion on the matter is they should pay for the opportunity of doing business with us, and they should be glad and thank us the whole way out. And that's his opinion. I'm not even saying if I agree with this right or wrong, but there's no way he's going to pay him, right?
Yeah. Or he will say this is for services rendered.
Yeah. How about that? Bobby, you want one more question and then we'll play the whole thing out?
Yeah, no, I do want one more question. I want to ask about rates in general. Jimmy had his thesis on what's happening with rates, and I agree with him on that. Where is the level on the 10-year, the 2-year, or interest rate duration of your choice that really starts to hurt?
Well, so most of our fixed income that we have is all 2 years or less. And that is honestly, though, it's a function of me just not knowing and therefore not wanting to make a bet. So what I mean by that is
very fair.
My guess is that the 10-year probably stays around these levels, bounces between 4% and 5%. If it goes to 3% or 2%, I think it will be because the economy is slowing very fast or there is some kind of a crisis. And I have other things that will make money in that type of an environment. So I'm not playing it via rates. I also think that just because of the situation the whole world is in, and this is not a US specific thing, the whole world has too much debt. The whole world has these problems. And if rates go higher as a result of conflict or inflation or non-cooperate, whatever the reason, I think the U.S. is better able to handle those higher rates than the rest of the world, which again brings me back to investing in the United States rather than abroad. I cannot now. Let's say the 10-year goes to 6%, just as an example. That would be a tough thing for the United States. But can you imagine what it would do to emerging markets? Like, who's going to buy an emerging market bond if you can buy a U.S. bond, paying 6%? Like, I think from a competitive standpoint, that would help the United States draw investors in. And if the higher rates put pressure on corporate borrowers in the U.S., I think it's going to put even greater pressure on corporate borrowers in the Eurodollar market. So no matter how I play this out, whether it's a good scenario or a bad scenario, I just keep coming back to, I think the best place to be invested is the United States. It gives me the best opportunity. It gives me the best liquidity. It gives me the most optionality. And if I'm wrong, it's because I probably didn't make as much as opposed to, not making anything at all. And if everybody goes down together, then I would much rather be in the U.S. than be, overseas somewhere. So, again, I don't know, that served me pretty well over the last 5 or 6 years. Whether that continues to, time will tell. But
I love that thesis. By the way,
you mentioned you that are very emotionally involved with this U.S. World Cup. Bosnia and Herzegovina is plus 700 right now. So you could literally bet $100 to win 700, and then you're happy if the U.S. wins or if they lose.
Oh, that's a good trade.
That's an emotional hedge. I do that with the Bears against the Packers every single game.
You bet on the Packers?
Are you talking about the Indiana Bears?
Oh, just stop that. Just stop it now. They were gonna, my restaurant is 2.5 miles from the Arlington Heights Stadium site, as we've talked about. So yeah. By the way, before we get into, because I do want to talk about basketball for a second too. When you said trucking, is Craig Fuller one of your go-to guys?
Yes.
On trucking?
Yes.
Okay,
that's the guy.
Because I've been meaning to mention to Bobby, because I've been in contact with him, and I think he's really, really good and thorough, and I'd love to get him on. He's also eloquent. He talks pretty well too. So, Craig, if you're watching this, I am going to send you a message. But now, okay, Nebraska, how many players did they lose off that good team from last year? Quite a few, right?
On the basketball team?
Yeah.
Yeah. I don't know the exact number, but it was quite a few.
Right. So we're not viewing them necessarily. I mean, he's a great coach. Maybe he gets them all coached up. But as we're looking at it now, they're not a top 25, top 30 team, you think?
I think they could be top 25, but I don't think they're going to be top 10 like they were last year.
Right. And when you look, and by the way, everything is just a path to talk about my Illini team. I don't give a shit.
Yeah, I know. I was waiting. Waiting.
You're waiting. I know. So even though we lose Keaton Wagler, looks like we reload pretty good. I mean, we're going to open up the season like top 3. Do you think that's fair?
I don't know about top 3, but I think it definitely top 10. And I told Brad Underwood was one of my coaches at a basketball camp that I went to. So I've always kind of followed him, and I think he's a great coach. I think he's done a great job there. Did he follow Self, or did somebody come between him and Self? So
Self, then Bruce Weber.
Oh, that's right, Bruce Weber.
Then John Gross, then Lon Kruger. So we had like 2-year coaches, and then finally,
we just lost.
But I think he's done a good job there
right now. Just so you guys know,
just go like the Seattle mayor said. You don't want to talk about basketball? Bye. Just kidding, people. Don't go.
By the way, how many Indiana Fever wrestling matches have you been to, Brent? Any?
I've never. I coach girls basketball, and I still can't watch girls basketball.
It is just so messed up. It is just so ridiculous.
Yeah.
Do you believe it, though? Let me play it out to you. Okay, so Caitlin Clark is getting her ass beat. All of a sudden, a girl emerges who's 6'2" and looks like a Victoria's Secret model who comes in to be the savior. If I was going to be writing the script, that's exactly how I'd write it. Is it 100% believable that's really what's going on?
I mean, I guess you never really know, right? But that meme of her like walking around pointing, that's like my new favorite meme.
I've done it like 3 times.
That will live forever.
It will.
I've done it to my wife because she walks through the kitchen.
And especially her head tilt was right.
I love her. Right.
She was awesome.
Yes. Okay, that's gonna do it. He is Brent Johnson. You guys all follow him already, but I'll tell you where to find him anyway. That's at Santiago Capital on Twitter. He's one of the best followers. He's one of the best guys. It's so much fun to talk to him. Thank you so much for being here. I'm Jim Iuorio. That's Bob Iaccino. This has been the Trader's Edge.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.